welcome to Value Research Helpline. I'm Ruchira and our experts here at Value Research are now all set to answer your queries on investing and personal finance. Joining me now is Ashutosh Gupta, who heads the mutual fund research team at Value Research. Welcome, Ashutosh.
Thank you, Ruchira.
Now, today's first question has been sent in by Avijit, who wants to know, how can a nominee claim the money invested in a mutual fund in case something happens to the account holder?
Well, the nominee would need to fill up a transmission request form, which is available with the fund house. And along with this form, he'll have to complete some documentation like the death certificate of the original account holder, the bank account details of the nominee, a cancelled check, and so on and so forth. And upon completing these formalities, the ownership of the units will transfer to the nominee, and then he'll be free to decide whether he wants to continue to remain invested or he would want to redeem and get the money. And if he does decide to redeem those units, then for the purpose of calculating the capital gains tax liability, the original holding period of the original account holder would also be considered.
Now, the next question has been sent in by Jeevan Dabra, and he asks, what should be the maximum percentage allocation to mid-cap and small-cap funds in the portfolio of a 50-year-old aggressive investor?
Well, there is no set percentage, but the broad guideline is that these funds are meant for a supplementary allocation. So even in case of an aggressive long-term investor, mid-cap and small-cap funds should not have more than 25-30% allocation of the overall portfolio. Now, in case of this gentleman, more than his age, it should be dependent on his investing need. So if let's say he is looking to use this money to derive regular income, say 8 to 10 years down the line, which is approximately the time when he may be looking to retire, then I'd suggest he should avoid investing too much in mid and small cap funds, or pare it down if he already has those investments, and stick to the more mainstream flexi cap kind of funds because they themselves have a limited exposure to mid and small caps, and that should be good enough. But on the contrary, if he is not looking to derive regular income from these funds, from these investments, and he can continue to remain invested for say 12-15 years or more, and he already mentions that he is an aggressive investor, then he can continue to have these investments in his portfolio subject to that 25-30% upper limit to these allocations as I just mentioned.
Alright, now Rakesh Prasad wants to know, how reliable is the riskometer considering the fact that it failed to catch the risk in the debt funds of Franklin funds?
Well, he's right. The earlier version of riskometer was not effective enough to call out the additional risk in the Franklin funds. That's because the earlier version of the riskometer assigned risk grade at a category level, and all funds within that category used to get the same risk grade, irrespective of the underlying differences in their risk profile. Now, typically, if we look at the debt funds, most of the debt fund categories by regulatory mandate have a restriction on either the kind of duration that they can maintain or the kind of credit quality. So, for instance, if we talk about short duration funds, regulations mandate that these funds have to maintain a duration in the band of 1 to 3 years, while the credit quality is left to the discretion of the fund managers. So, you see that often funds differ significantly in terms of the credit quality of the bonds that they invest in, and therefore their underlying risks differ substantially. But this kind of a nuance, the earlier version of the risk grade was not capable to identify and call out. But that has changed with the revised riskometer methodology, which has come into force from January this year. Now, the risk grades are assigned on the basis of the underlying holdings of a fund. And we did a detailed study on this. In fact, we published that in our monthly magazine Mutual Fund Insight last month, and our study finds that the new riskometer is effective in identifying and highlighting the additional risk in some of the fund categories, some of the funds in certain categories. In fact, there are a lot of categories where funds straddle across 3 risk grades. There are also some categories where the funds are spread across even 4 different risk grades. So clearly, to that effect, the riskometer, the new version, has been much more effective. And I believe had that been in force earlier, sometime last year when the Franklin episode happened, at that time it should have been effective in highlighting those additional risks in the Franklin funds. But now that this new riskometer is available, the onus is on investors to take note of it, to monitor it regularly, and ask questions to their fund companies if they see the risk in their funds rising. And this information one can easily get from Value Research website in the fund listings under the risk stats section.
Now, Ravi Rajan has investment in short duration, corporate bond and banking and PSU funds, and he wants to know if these investments have become riskier due to the new additional Tier 1 rules proposed by SEBI.
Sure. So firstly, I'd like to point out that the additional Tier 1 bonds or AT1 bonds, as they are popularly known, are a riskier variety of bonds, and the new SEBI rules has got nothing to do with it. That's because first of all, these bonds do not come with any set maturity date, and the issuer can choose not to redeem them at all. That's number one. Second is that these bonds have a weaker claim on the assets of the issuer. So in case the issuer undergoes any financial troubles, then these bonds can be completely written off. In fact, that's what happened in case of the 81 bonds of Yes Bank last year. So clearly these are some of the inherent features or attributes of these bonds which make them riskier. Now coming to the SEBI provisions, the recent revised regulation that SEBI came out with, because of which there has been a lot of noise in the markets. So one is that SEBI mandated that because of these inherent risks in 81 bonds, it put an upper limit on how much mutual funds can invest in those bonds, and that is a good development from a risk standpoint, because it will ensure that fund managers do not go overboard on these bonds in pursuit of higher returns. But secondly, and more controversially, SEBI mandated that to calculate the value of these bonds, for the purpose of valuation of these bonds, fund companies should assume the maturity of these bonds to be 100 years. Now, without getting into the technical details around it, this particular provision would have almost certainly caused a drop in the value of these bonds, and on an ongoing basis also made them more volatile, and that is where the apprehensions of the fund companies and broadly the markets lie. Now there can be arguments made for or against this valuation norm, but they may not matter from here on as such, because the finance ministry has written to SEBI asking it to withdraw these valuation norms. So while more clarity from SEBI is awaited, but it is very likely that this valuation norm might be dropped altogether or maybe substantially toned down. So that is where we stand currently. The upper caps that have been put on investing in these bonds would only make the bond funds safer. But the valuation norms, which could have potentially made these funds or these bonds more volatile, they might be dropped altogether or maybe substantially toned down.
A.K. Gopal has sent in the next question. He asks, for regular income post-retirement, why should one invest in a mutual fund when investing in bonds directly can fetch regular interest as well as the principal amount at the end of the tenure, whereas in mutual funds you can exhaust the entire amount in SWP mode?
Well, so firstly, the rate of interest from a bond or the rate of return that you can get from a bond does not change irrespective of whether you invest in it directly or indirectly through a vehicle like a mutual fund. Now, what mutual fund does is to convert the interest income from a bond into a capital gain, which over a longer holding period of more than 3 years is actually beneficial from a taxation perspective. So, if you hold a mutual fund, a fixed income mutual fund for more than 3 years, then the capital gains that you derive from it are taxed at the rate of 20% after providing the indexation benefit, which is a beneficial tax treatment. That's number one. The second advantage that a bond mutual fund offers over directly investing in bonds is that of diversification. Because of the limited investments of an average retail investor and because of the large ticket size involved in investing in bonds directly, one may not be able to diversify adequately by investing directly in them. But in case of a mutual fund, even with small investments, one can achieve diversification by investing in a basket of bonds. That's number two. The third benefit of mutual funds is liquidity, because a mutual fund stands committed to honor your redemption request. Of course, barring incidents like the Franklin episode, a mutual fund stands committed to honor your redemption at the applicable NAV on any working day. So those are the kind of advantages that you have by investing in a debt mutual fund over investing directly in bonds. Now coming to his point around exhausting his investments in a debt fund through SWPs, well, that would be a function of your withdrawal rate in the first place. If one restricts one's annual withdrawals through SWP to the tune of broadly the kind of returns that a debt fund is able to generate, then he would not end up exhausting his corpus.
Okay, now Ankit Mundra wants to know how important are the PB ratio and PE ratio while selecting a mutual fund? Should they dominate the decision?
Well, the PE ratio and the PB ratio are essentially valuation measures, and they tell you about what is the kind of premium that the markets are willing to pay to every rupee of a company's earnings. So typically stocks which the markets expect to grow at high rates from here on tend to command a premium, and therefore they tend to have higher PE ratios. Now in case of mutual funds, a PE ratio is simply the weighted average PE ratio of all the stocks that it holds in its portfolio, and typically funds that follow a growth style of investing would tend to have a higher PE ratio, while the ones which are value oriented or follow a contrarian style of investing, they would tend to have a more moderate PE and PB ratio. Now regarding the question of how to use that in investing decision making, well, I'll suggest that right at the outset, the focus should be on identifying funds and fund managers which have a track record of doing consistently well through multiple market cycles. So one should look for funds which have done consistently well through the ups and downs of the market and avoided big disasters. Now once one has been able to zero down on a narrow list of such funds, then one may refer to these valuation ratios of a fund like a PE ratio to bring in some style diversity in his selection of funds which he wants to eventually add to his portfolio. That's because if you look at long terms, you would see that funds which follow different investing styles would still have done well consistently over a period of time. So it may not hurt to bring in some style diversity, some growth as well as some value flavor in your portfolio, and for that one may refer to the PE ratio as the last check.
Now, Arun Ramachandran asks, is it a good idea to invest in funds focused on Europe, or should he stick to the US when it comes to international exposure?
Well, I'd prefer the US allocation for your international equity side of the portfolio, or even the global funds. But then again, even the global funds would usually have a dominance of the US listed companies in their portfolios, and there are reasons for that. One is that the US markets probably offer the widest choice of fundamentally strong and globally competitive businesses. In fact, you'd come across several technology or consumer businesses which are even household names in India, but you cannot invest in them in the domestic markets. So getting exposure to these fundamentally strong global businesses is one reason why you should stick to the US markets. The second is on the exchange rate side, because remember, when you are investing in international markets, you are also indirectly assuming the currency risk. And from that standpoint, the US dollar happens to be the ultimate safe haven when it comes to currencies. So even from that standpoint, US markets make more sense. But one has to remember that with this kind of an international equity allocation, one has to take a more strategic view of things, because you would come across several compelling arguments, and there are expectations that after a sustained bull run in the US markets, it is about time that on a near-term basis from here on, the emerging markets may outperform the US markets. But I believe that for your steady state long-term allocation, there is still a very compelling case to be invested in the US markets.
Now the next query has been sent in by T. Parlapalli, who wants to know, what is the status of taxation of capital gains from mutual funds for NRIs, as there is a double taxation agreement with several countries which also tax capital gains despite tax being deducted at source in India?
So first of all, the capital gains on mutual fund investments for NRIs are taxed at the same rates as they are for the resident Indians. The only difference is that in case of NRIs, a TDS is levied at the time of redemption of those units, while in case of local investors, there is no such TDS that is levied. Now he's right that India has a double taxation avoidance agreement, or DTAA as it is popularly known, with several countries where the Indian diaspora is spread. Now, the tax rules governing these DTAAs could vary from country to country, but my broad understanding is that at a broad conceptual level, any income arising from investments is not exempt from tax in the source country, which in case of NRIs happens to be in India. So what happens is that in case an NRI has investments in India and there is a capital gain that arises through these investments, then the LTCG will be taxable at the rate of 10%, which he'll have to pay in India. Now, let's assume that in the country of residence of this NRI, say the long-term capital gains are taxed at the rate of 30%. So that country would provide him the tax credit for the tax that he's already paid in India. So for instance, if in India the tax rate is 10% and in his country of residence the tax rate is 30%, so he'll pay the tax at the rate of 10% in India, but his country of residence would provide him this 10% tax credit and charge his capital gains to tax only at the rate of 20% and not at the 30%, which is the normal rate applicable over there. So that is kind of the broad construct how the double taxation is avoided through these agreements. But as I said that the rules may vary from country to country, so it is best to seek advice from a tax consultant for a more nuanced and a more specific understanding.
Alright, now 53-year-old RK Gupta works with a private company. He has invested 15 lakh rupees in equity through VR stock advisor recommendations and another 15 lakh rupees in equity mutual funds. Besides, he has 50 lakh rupees in PPF and EPF. He'll retire in 2026. So should he continue in equity?
Well, I believe at an asset class level, he should continue with equity because he is about rupees 30 lakhs invested in equity, which is about 35 to 37% of his total corpus of rupees 80 lakh, including the fixed income alternatives. And we generally believe that that is a kind of allocation to equity that even a retiree seeking regular income from his investments should have to be able to generate inflation beating returns over long term. So from that perspective, I'd say that his equity allocation in the portfolio is good enough and he should continue. But what's more important is to focus on the construct or the composition of this equity allocation. So if this allocation is tilted heavily towards mid caps and small caps, then I'd suggest him to pare that down and restrict himself largely to high quality large cap companies. But if that is already the case, then it should be fine.
Deepika wants to know if it's right to invest in short duration debt funds instead of keeping them in savings bank account. She also asks, why does the price of short duration funds fluctuate on a daily basis when the instrument they invest in give fixed returns?
Well, she's right in the sense that the bonds do give fixed rate of interest, but the point is that these bonds also trade in secondary markets where the prices are subject to the ups and downs, and that's why there are fluctuations in the prices of these bonds. Now, for somebody who invests in a bond and holds it till maturity, these ups and downs are only notional because irrespective of these market movements in the bond price, the investor would still continue to get the interest at a fixed rate, and upon maturity, he'll still get back the full principal amount. But because mutual funds have to declare an NAV on a daily basis, and which is mark to market, which means that the bonds in the portfolio are valued at their market prices, that's why there are ups and downs in the NAVs of the bond funds on a day-to-day basis. Even though these fluctuations are not of the magnitude that one sees in equity markets, but they are certainly there. Now, coming to her question about the suitability of short duration funds, well, I'll say yes, if her investment horizon is not limited to the next few months only, then short duration funds should still be a good option. Now, if we look at things from here on, there is a general expectation of a rise in bond yields from here on. In fact, bond yields have already been on the rise since the start of the year, and directionally they are expected to continue to move up from here on, and that generally has a negative impact on bond funds. But given that short duration funds invest in bonds of fairly short maturity of about 1 to 3 years, that is a kind of Macaulay duration that they have to maintain. That's why the impact of these interest rate movements or the upward bias on yields on these funds is going to be limited. And on top of it, they'll continue to earn from the interest income that they receive from the underlying bonds that they hold. So I'd say that if your investment horizon is say 2 years or upwards of that, then these funds should be fine.
Alright, now Shyam Kumar asks, are there any perpetual bond holdings in the Analysts Choice list of funds recommended by Value Research?
Well, our fund analysts are very conscious of the exposures of a fund to perpetual bonds, and the ones that invest substantially in them do not make it to our recommended list. So going by our current selection of funds in the hybrid and debt category, most of these funds either have no or low single digit exposure to perpetual bonds. In fact, just last week we put out a note to our premium subscribers detailing the level of exposures that our recommended funds have in perpetual bonds, and we did that just to address the anxieties the investors had given all the noise around perpetual bonds that erupted last week. So I'd say that rest assured, that is something that our analysts continuously monitor and track closely. In fact, just some time back we had pulled a fund out of our recommended list simply because of its rising exposure to 81 bonds, which form part of these perpetual bonds. So I'd say rest assured, this is something which we actively monitor, and we'll keep you posted.
Okay, now today's last question has been sent in by Shubha Malvia, who's asked for your suggestion on a lump sum investment in Axis Midcap Fund for an investment horizon of 7 years or more. It's over and above her SIP in the same fund.
Okay. So I'd like to point out a few things to her. One is that her choice of fund is fine, but lump sum is an undesirable way to invest in this fund. More so because this is a mid-cap fund which may be subjected to a greater level of volatility through the ups and downs of the market. So she should look to spread her lump sum amount over at least a few months to maybe even a couple of years, depending upon how sizable is this amount in the context of her finances. So that's number one. Second thing I like to point out to her is that I generally avoid suggesting a mid-cap fund for an investment horizon of less than 10 to 12 years. So that's something that she should consider. If she's looking to invest strictly for about 7 years or thereabout, then maybe she can consider flexi-cap funds, which by themselves have a limited exposure to mid and small cap funds, mid and small cap stocks, and that should be good enough. And finally, I would suggest that if she does decide to go ahead to invest in this fund, then she should look at this as a supplementary allocation and not invest a substantial portion of her overall portfolio in this fund. So an allocation to the tune of not more than 10 to 15% should be good enough. So those are the kind of considerations that she should keep in mind.
Well, with that, it's a wrap on this episode of Helpline. Thank you, Ashutosh.
Thanks, Ruchira.
Thank you to our viewers. You can go to VR Helpline on Value Research Online and send us the questions that are stopping you from investing today. Our team will answer them in the upcoming Q&A session. Bye for now.